Hello everyone and welcome back to another video. So over the weekend, Warren Buffett and Charlie Munger held their annual meeting for Berkshire shareholders. Every year, this event is streamed live and thousands of people from all over the world tune in to hear what these two investing legends have to say. Personally, I watched the entire event and I found some key highlights that I want to share with all of you because I think these are the main things that apply to stocks today. These clips in specific talk about whether the stock market is overvalued right now, how bad inflation is, and a lot more. So let's just play the first clip and I'll see you guys all on the other side.
Well, let me ask a follow-up question on that then. This comes from Jack Sang, who says, what's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks, gaining 50%, 100%, 200%, etc. in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. Well, it gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. The U.S. Treasury they had applications on the 4-week Treasury bill for 100 and some billion. They accepted bids for 43 billion worth. Average price 100.000000, 6 zeros. And essentially, people were giving 40-some billion dollars to the Treasury, and they offered to give 130 billion or something, whatever the amount tendered. And the Treasury received the money at 0%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough right now, nothing. And here we are in this world where we had 0 interest rates last week or this week on a four-week note, and Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. Before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get 20 million. Imagine your wages going from $15 an hour to 20 cents an hour. So it's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. And if present rates were destined to be appropriate, if the 10-year should really be at the price it is, those companies that the fellow mentioned in this question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to 0 interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better, And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. And so we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we, Charlie?
Yes, and the professional economists, of course, have been very surprised by what's happened. It reminds me of what Churchill said about Clement Attlee. He said he was a very modest man and had a great deal to be modest about. And that's exactly what's happened with the professional economists. They were so confident about everything. And it turns out the world is more complicated than they thought.
As a follow-up to that, Pat King, what's your opinion about the economic theory MMT, especially the United States, because it's the reserve currency for the world?
Well, I think I think the modern monetary theorists are more confident than they ought to be, too. I don't think any of us know what's going to happen to this stuff. I do think there's a good chance that this extreme conduct is more feasible than everybody thought. But I do know if you keep just doing it without any limit, it will end in disaster.
All right, so Warren Buffett covers a lot in this clip, so I'm going to do my best to explain everything quickly. The first thing that he says is that valuations are actually not crazy right now, and if interest rates remain low, then stocks are still cheap. This is because interest rates act like gravity on stocks. So the higher interest rates go, the lower stocks go, and the lower interest rates go, the higher stocks go. So basically, when interest rates are at zero, the gravity on stocks is also set to zero, and they can really just keep going up and up and up. This is because there are two main markets to put our money in, and this is the bond market and the stock market. When interest rates on bonds are low, there isn't much incentive to put our money into bonds, and there is much more incentive to put our money in stocks. We have actually seen this correlation throughout history too. Back in 1981, interest rates topped out at 20%, which means investors could buy bonds and get a near 20% guaranteed return on those bonds since they are backed by the Federal Reserve. If we go and take a look at the price to earnings ratio of the S&P 500 during this time, we can see that the PE was sitting around 7. I like to think of the price to earnings ratio as the demand for stocks. And here in the 1980s, we can see that the demand for stocks was incredibly low. And again, this is because interest rates were high, which made the yield on bonds way more attractive than stocks. So the higher interest rates go, the more money leaves stocks to enter bonds. Now, we can also see that interest rates have slowly been making their way to zero since hitting their peak in 1981. As interest rates have continued falling, the price to earnings ratio in the stock market has continued uptrending. The PE in the market bounces around like crazy, but we can clearly see that the overall trend has been up, and this is because the trend of interest rates has been going down. So now that interest rates are right at zero and no one can get a return on bonds, all that money is finding its way into other assets, like the stock market. This is why price to earnings ratios are skyrocketing, and I believe they will continue to do so until interest rates start to move up again, and it sounds like Warren Buffett agrees. He actually said that if interest rates remain at zero, then stocks are still cheap. So the longer interest rates remain at zero, the more we can expect stocks to continue moving up. Recently on my channel, I went over JP Morgan's research on the macroeconomic environment. In that research, I showed that the global bond market is currently worth $130 trillion. This means that there is essentially $130 trillion out there that is not earning very good returns right now. The longer this money continues earning zero returns, the more it will find its way into other assets, which again is stocks. This also means that the biggest risk to the stock market and valuations right now is rising interest rates, and a lot of this money finding its way out of the stock market and back into bonds. So when you hear investors in the market freaking out about the 10-year bond yield and interest rates, this is why. Now, the Fed has said that they do not want to increase interest rates until at least 2023. However, Warren has also said that things can change very quickly. This is because the only way to fight inflation and slow it down is to increase interest rates. Increasing interest rates puts the brakes on our economic activity, and it really slows down all of our growth. So if inflation is increasing rapidly and getting out of control, then the Fed will have to increase interest rates, which will harm stocks and valuations. Warren is saying that this could potentially be the side effect of all of the stimulus that we have done and the low interest rate environment that we are currently in. Basically, if we overdo stimulus and inflation picks up, then interest rates will rise to fight this inflation. This is also why we hear so many people worrying about inflation, because inflation means rising interest rates, and interest rates rising is the biggest risk to stocks right now. Rising interest rates or inflation will end the high valuation stock market party that we are currently in. So let's move on to the next clip and see what else Warren Buffett has to say about inflation right now.
I will ask this question from Chris Freed from Philadelphia, and whoever wants to take this on stage. From raw material purchases by Berkshire subsidiaries, are you seeing signs of inflation beginning to increase?
Let me answer that. Greg can give more. We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. Take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up. And there hasn't yet been, because the wage stuff follows. I mean, if the UAW writes a 3-year contract, we got a 3-year contract. But if you're buying steel at General Motors or someplace, you're paying more every day. So it's an economy really, it's red hot. I mean, and we weren't expecting it. I mean, all our companies, when they thought when they were allowed to go back to work, at our various operations, we closed the furniture stores. I mentioned, they were closed for 6 weeks or so on average, and they can't stop people from buying things, and we can't deliver them. And they say, well, that's okay, because nobody else can deliver them either, and we'll wait for 3 months or something of the sort. But the backlog grows, and then we thought it would end when the $600 payments ended, and I think, around August of last year. It just kept going, and it keeps going, and it keeps going, and it keeps going. And I get the figures every week. I call, or Bumpkin calls me, and we go over day by day what happened at 3 different stores in Chicago and Kansas City and Dallas, and it just won't stop. People have money in their pocket, and they pay the higher prices, and when carpet prices go up in a month or two, we announced a price increase for April. For our costs are going up. Supply chains is all screwed up, for all kinds of people. But it's almost a buying frenzy, except certain areas you can't buy yet. You really can't buy international air travel, and so the money is being diverted from a piece of the economy into the rest, and everybody's got more cash in their pocket except for it is not a price sensitive economy right now in the least, and I don't know exactly how when it shows up in different price indices, but there's more inflation going on quite a bit more inflation going on than people would have anticipated.
Yeah, and there's one very intelligent man who thinks it's dangerous.
In this clip, Warren says that he is seeing substantial inflation and rising prices in their own businesses. He actually said that Berkshire Hathaway is starting to increase their own prices as well. If we take a quick look at commodity prices, we can see exactly what is happening right now. Lumber prices are absolutely skyrocketing and are up near 300% from where they were before the pandemic. Oil prices are up nearly 300% year over year. Corn prices have doubled in the past year. Copper has also doubled, and even coffee is up 50%. All of these commodities are up quite substantially right now, and inflation tends to follow what commodity prices are doing. This is because lumber prices increasing means home builders need to pay more money for the lumber they use to, build homes. And since home builders' costs to build go up, it means that they need to pass these costs on to their customers to continue generating profits. This means new home prices go up, which also means that all home prices start to go up as well. This same thing goes for oil and gasoline. If gas prices are increasing, then the cost of transportation increases, which means that virtually everything that needs to be shipped increases in price. Our food in grocery stores is moved by trucks that run on fuel, and if fuel becomes more expensive, then their shipping costs go up, which means the price of shipped goods goes up to continue generating these companies' profits. So once commodity prices start increasing, then it slowly starts trickling down throughout the entire economy, which is also exactly why Warren Buffett said that Berkshire is starting to increase their own prices, because they need to do so to offset the increased costs that they are seeing. Warren said that there's just too much demand out there right now, even in his furniture business, and it's just not stopping. Supply chains cannot keep up, and there is a shortage of supplies like we saw with lumber, steel, and etc. Since supply is being constrained and demand is increasing, you get a clear raising of prices or inflation. Now, one thing that Warren did say is that there is a whole area of the economy where people can essentially not spend any money right now. This is like airlines, hospitality, cruises, traveling, and etc. So all of this money is finding its way around into other parts of the economy. And hopefully this will mean that when the global economy and supply chains are opened back up, that inflation will slow down and commodity prices will come back down to earth. But in the meantime, we are most definitely seeing inflation, and we could potentially see even more before this is all said and done. If inflation continues heating up, then there is a real chance that the Fed will have to increase interest rates before 2023 to slow it down, which again is the largest risk for stock market valuations. Unfortunately, no one can predict what interest rates will do exactly and when. So I strongly believe that investing in solid, fundamentally sound businesses over a long time horizon remains the best investing strategy, even right now. We cannot control or predict interest rates, so I do my absolute best to completely disregard them when I am investing and controlling my own portfolio. But anyways, there's just one more clip that I found interesting, and it was when Charlie Munger was asked directly about his recent Alibaba investment. So let's just quickly watch this clip.
This question's for Charlie. It comes from Stephen Tedder in Atlanta. He's been a Berkshire shareholder for 10 years and says, what are your current thoughts on China and whether the communist leaders will allow businesses with strong leadership to flourish in decades to come?
Well, I think that the Chinese government will allow businesses to flourish. It was one of the most remarkable things that ever happened in the history of the world when a bunch of committed communists just looked at the prosperity of places like Singapore and said, the hell with this, we're not going to stay here in poverty, we're going to copy what works. And they changed communism. They just accepted Adam Smith and added it to their communism and said, now we have communism with Chinese characteristics, which is China with a free market with a bunch of billionaires and so forth. And they made that shift. They deserve a lot of credit. Warren and I are not quite as good at that as changing our minds in many cases.
Yeah.
And that was a remarkable change coming from such a place. And of course, it's worked like gangbusters. It had this enormous growth in the average income of the average Chinese. They've lifted 800 million people out of poverty fast. And there was never anything like it in the history of the world. So my hat is off to the Chinese. And I think they will continue to allow people to make money. They've learned it works. The Chinese, I loved what the guy said in the first place. I don't care whether the cat is black and white as long as it catches mice. That's my kind of talk.
Alright, so Charlie just said that he believes China will allow their businesses to continue flourishing. He believes this because it was China's acceptance of some sort of capitalism that lifted a large portion of the country out of poverty. If they do not allow their businesses in the economy to continue flourishing, then they stop this lift out of poverty, and they stop their competition on the global stage. Charlie basically believes it's in China's best interest to allow their businesses to continue succeeding. If you have ever listened to Charlie Munger speak about China in the past, then you should know that he does admire this country and just how great their economy has boomed over the past couple of decades. So his bet on Alibaba is basically him saying that he believes the country will continue growing in the future and that the Chinese government shouldn't slow down this growth. Alibaba is also a stock that I recently covered in my top 3 cheap stocks in this market video. So if you want to hear why Alibaba could be considered cheap right now, then I would recommend going and watching that video. Also, if you're someone who wants to know how to invest to fight inflation, then I will be doing a full video on my channel talking about the different types of investments and why they're good to hedge against all of the potential inflation we are going to see soon. So if you want to stick around and see that video, then please make sure you subscribe to my channel. But that is pretty much going to wrap everything up. And if you found this video helpful or useful in some way, then it would also be awesome if you could leave a like on it. Leaving a like on the video really helps out my channel, and again, I really appreciate it. But that's pretty much going to wrap up the video, everyone, and thank you all so much for watching. Truly, I do appreciate you all coming by, checking out my video, and if you made it to the end, then God bless you. Seriously, that's awesome. And I really hope to see you all again in the next one. So take care, everyone, and I'll see you all later.